Let's continue our packet work, and today the topics are dividends and stock splits. At the end of this particular document, we're going to have the outline. I'm going to cover the outline in a separate voiceover. For the previous modules, I think you could get at what was important in your outlines from what I gave you within the modules. It's very convenient for me to discuss because I actually like the format of the outline for this chapter, and I'll be handling it that way. Learning Objective 5, the new stuff for you that you might not have had in other classes is a stock dividend. You should have already had exposure to cash dividends, so stock dividends is a new issue. And stock dividends is a distribution of additional shares of stock to common shareholders. And it is said to current, but it's common. It's the common current shareholders. You usually don't do stock dividends for preferred. Is it possible? Yes, it's possible, but it's usually not done. Because the stock dividends, the reasons why you do these are to really influence your stock price, and you're not as concerned with the stock price of preferred shares. For a small stock dividend, and the cutoff here is 25% or less. That would be 25% or less is the number of the outstanding shares. So the shares you had outstanding before you issued your dividend, how many additional are you issuing, and put that over your original amount to determine the percentage. That's how that's calculated. When it's little in value and you are going to say you're going to do a stock dividend, the accounting for that is going to be transferring the fair value, which is the market value, from retained earnings to paid in capital. And this is very loosely said because it's going to be a common stock and a paid in capital common stock account. And it's going to be handled the same way as you would if you were, say, issuing those shares. And if you issued the shares, you'd have a debit to cash for the cash coming in, and then a credit to common stock and a credit to paid in capital common stock. The difference is that you're not getting cash in, and you're going to be instead debiting retained earnings. Now, this is the market value, which means market value is usually much greater than par, and that would be a very big hit to take to retained earnings if it was a large amount of dividend. In other words, there's a lot of stock being issued in this dividend. So if you have a lot of stock, and again, the cutoff is 25%. If it is 25% or higher of your existing outstanding shares, then you're only going to value that retained earnings debit as the par value, and you're not going to use market value. So to do this, then you're not in effect taking so much out of retained earnings. The other option you have is to say that it is a stock split, which is effected in the form of a stock dividend. And to do that, you would actually have a stock split, but when it says effected, it means the journal entry that you do will be based upon considering it as a stock dividend. So it's referred to as a stock split, and that's the way effectively you want to do it. You won't do a journal entry. However, if you want to do a stock dividend and you want it to show up as a dividend and you say effective as a stock dividend, that's what we're talking about here. So we'll be talking about stock splits and stock dividends. This particular bit is going to be on dividends. So the next question says, the prescribed accounting treatment for stock dividends implicitly assumes that shareholders are fooled by small stock dividends, the benefit by the market value of additional shares. Is this logical? It is not logical because the value of each share, if the value were to remain the same when additional shares are distributed, the total value of the company would simply grow. And what we are saying here in this is that the value of the company is not going to be growing. Instead, what's going to be happening is the value of each share, individual share, would change. The reasoning behind the different treatments for small and large stock dividends is that the large stock dividends would transfer too much from retained earnings to contributed capital. To avoid reducing retained earnings altogether, the company could say that it is they want to effect it in the way of a stock split. They can effect the dividend as a stock split, which means that they wouldn't have to do the journal entry at all, and there would be no effect on retained earnings. So we'll discuss that coming up. Here is a cash dividend. This is mainly a review for you. Microsoft announced that it had declared a quarterly dividend of 36 cents per share. I might have mentioned before that once you start on dividends, if you discontinue your dividends, then it will have an adverse effect on stock price because shareholders build into their valuation of stock that dividends will be paid. The important dates here are the dates that the dividend is declared and the date in which the dividend is paid. Those are the two dates that are also important when you're recording stock dividends. When you declare is when you create the payable. It is also the date at which you would establish or create the common stock distributable. Both of those things will be eliminated when either the dividend is paid in the case of cash or the stock is distributed in terms of common stock. So those are the two important dates. Prepare the journal entries for this, assuming there's 7.87 million, I guess this is billion shares of stock outstanding. Well, the debit amount is going to go on the declaration date to retained earnings. Had this been common stock and not a cash payment of a dividend, you would see the same sort of thing happening, a debit to retained earnings, only it's not a payable because it wouldn't be cash, it would be the common stock that would be going out. And then on the payment date, it's the same thing as if you paid off an accounts payable. When you actually pay it, it's removed. You had a liability, the liability is removed. So this should be something that's just kind of a review for you. In 1811, we were talking about preferred stock and preferred stock dividends. I'm not going to give you, as I've mentioned before, problems that are participating, non-participating. You are going to assume that all you are really concerned with in your problems is whether it's cumulative or non-cumulative, and again that means whether any arrearage will be paid. The stockholders, the board of directors here are declaring cash dividends. To have preferred dividends paid, to have dividends paid on preferred stock, you have to have the dividends declared. And they don't separately say we are going to pay cash dividends to our preferred shareholders. They just say we're going to pay cash dividends. And then you have to go through, and this is the table I was talking about. So after we complete this, you might want to go back and you might want to look at I think there's two problems in the voiceover lecture, and you could create the table and just for yourself and work through it, because I like to give a problem like this on the exam. So the preferred stock is cumulative in case, then if they're not paid a dividend, they get a dividend in arrears, and they have a preference for payment for dividends provided that a dividend is declared and their preference is over the common stockholders. And there's no statement anywhere that says what common stockholders should be paid. Again, if you want to keep your stock price up for your common shares of stock and you pay dividends sometimes, you would probably want to be consistent in how you do it because the market builds that in. The first thing, of course, is to get everything in the proper order. And you notice here it says 2018, and then it goes here in 2017 and 16. So a pet peeve I have, of course, of all the problems is be consistent. Are you going to say 2016, 17, 18, or are you going to work backwards? So when you work through the problems, you have to identify which goes with which, and so I would create the table starting at the left and put in the dates in chronological order, and then I would insert the declared dividends column so we get that straightened out. The amount in every single year is going to be the number of the book value, I should say, of the preferred, and I said book value is simply issued times par, right? And then times a percentage. Now, in our case, we have no change in the number of preferred shares outstanding for 3 years, so it's the same number. It's always 24. If you had issued more shares of preferred, you would have these numbers changing because your book value would change. It's 24, and we had 20 declared in 2016, so we're going to pay them only the 20. We can't pay them the 24 because we only declared 20. So that's a problem. The preferred are really owed. I say they're owed, but notice you don't pay them interest. Even though they're owed, they're not being paid any interest. And the poor common shareholders get nothing because it's inadequate. So if you wanted to make it adequate and make sure that your common got some, you would need to declare your dividends, assume this is the first year of operation, for more than 24, because 24 would cover your preferred, and that would give you a little more to pay to the common. Second year, they didn't learn anything. They're still going to pay 20, which means now we have 4 in arrearage from the first year of 2016, 4 in arrearage for 2017, and I say it's owed to preferred, so they're owed 8. No interest is paid on that. They don't get any interest. They just have 8 hanging out there that they need to be paid. I think this is in millions. So and then 2018, we got a little smarter here, and we say, okay, let's declare dividends of 50. Maybe they had a good year. I don't know. So they have declared dividends of 50. They have enough to pay completely the amount which cumulative should be getting for this year, the preferred amount for this year of 24, and they can also go back and pay back for those other 2 years the 8. So that's what they'll do. Preferred then will be, I think, happy to have been paid the arrearage and to be paid completely the amount 24 for this year, so they get 32. And since we have paid 32 out of the 50, we have 18 left. I want you to understand that the reason we don't pay any to preferred is the reason why we pay any at all to preferred, I should say, is because we declare dividends. If you did not declare any dividends, then they would have arrearage, and their arrearage for those years would be the total amount of 24 for each years. They don't get paid interest, by the way. So in a corporation, you tend to look at this and you say that this sort of a financing is kind of like interest because it's a percentage times something. But yeah, it's not quite interest, is it? But for the investor, it certainly is not an interest sort of a thing because there's no compounding on it. You can't make a comparison in investing in bonds versus in preferred in that way because the interest accumulation it doesn't occur. So it's a preferred investor in preferred stock. It's a little bit more like interest, but it's not exactly interest because you have no compounding and you have no guarantee that you'll be paid it, right? Had it been non-cumulative preferred, that's the other thing I want to make out, that $8 million that initially gets paid in to the preferred in 2018 when they finally get caught up, it wouldn't have never got it. It would have been completely lost. So If you see a percentage, I want you to assume that there's preferred dividends. And the only thing I really want you to understand is the cumulative versus non-cumulative aspect of it, and the cumulative will pay for the arrearages where a non-cumulative does not. Here is the way that they work through the problem. Again, I think it's better if you just build the table. You'll get the same results doing it this way. Some of you can do this and have no issues with it. As for me, I prefer the table. I like to see things all laid out in front of me. In exercise 1819, we are looking at stock dividends and discussing stock dividends. And you see that they've given you how the balance sheet equity section looks like. This supposedly is the whole thing. There's no treasury stock. There's no other paid-in capital accounts. This is everything for this company. And on June 30th of 2017, it looks like this. And then on April 1st of 2018, they are going to declare a 10% stock dividend, and it will be distributed on June 1st. So I said that important dates with all these dividends are the declaration date and the distribution date, and those are the two dates when you do journal entries. Now, the market price, which market price is important to us? The market price of most importance is the date on the declaration, because once it's declared, that's when we're taking out of retained earnings, and typically you would take it out at its fair value. Now, I said the exception is if you get 25% or more, because it's so big you don't use fair value, you use par. So I've kind of set you up here for the problem, and you have an idea of how to work through the problem. It lists in the common stock, it lists both issued and outstanding. So just as a review, if issued is outstanding, what does that tell you about the number of shares in the treasury? If you don't know, you need to go back and you need to review those concepts. What was the average selling price of 3 million shares that were issued? Can you figure that out by looking at the common stock accounts, the paid-in capital and the common stock? Now, is this a large or is it a small dividend? I've already told you that, right? And then this is the explanation of what we just discussed. And the reason why you're going to use the declaration date, because if you use the waited until you use the distributed date, the declaration itself might have affected the stock price. So there's things that happen in between times could affect stock price. You don't want those things. So let us go back and use the declaration values. Now, if at the year end, and it's such that your financials have to be prepared between this declaration and the distribution date, then you are going to put the common stock that will be distributed in this initial journal entry on the declaration date in a distributable account. And then you're going to remove the distributable account and show it as common stock. And in the solution which follows, that's the second one. If it's all done all together, you could combine it into one entry. And if you did that, then that's the solution that's the first one. And you could actually go back and see that they are combined. So I'm going to scroll on down here and we're going to look at these entries since I've given you kind of a heads up about it. Since this is a small 10%, the total amount coming out of retained earnings, the debit, needs to be market value on this date, which is the declaration date. Okay? And since it's all done, the assumption in the first April 1st transaction here is that it's all going to happen. It is all going to happen within the same financial statement period of time, declaration and distribution. Therefore, we aren't going to call it common stock dividends distributable, which you can see down below in the second set of solutions. you're just going to take it to common stock. Now, technically, it's distributable until it is actually distributed. But since it's all happening within a time period and there's no financials going to be prepared in between, we're just going to take it to common stock and call it common stock. The issue date, however, if anyone asks you what the issue date is, it's not going to be April 1st. It's when they're distributed. And by the way, these are going to show up, and it's going to show up in the total number of common shares outstanding. It's going to show up in common stock which issued. Okay, this is a part of it. Now, going down here, this is the alternative way to do it. And this is if you have in between April 1st and June 1st, you are setting out and preparing financials. You're doing a balance sheet. Well, in your balance sheet, I don't know what date do we want to say it is? April 15th, say we're doing financials, okay? You do April 15th financials. If you did April 15th financials, you would not want to say that you had common stock out there. So you would not want to record this journal entry as common stock because you do your financials on April 15th and it would be misleading. You don't have the common stock out there. So you call it common stock dividends distributable. Where does that show up? It's a paid-in capital account. It just has a caption on it that it is distributable. And if you go back and look in the paid-in capital accounts in our sections of the balance sheet that we've presented, you're going to see something like that. Now, on June 1st, you are going to remove the distributable caption and you're going to recaption it as common stock. Now, I know some of you are going to say, well, that paid-in capital in excess of par. How come you don't call that distributable on April 1st? And then why don't you remove it then on June 1st and call it paid-in capital excess of par from the common stock that's issued, and reclassify it like you're doing this common stock, kind of reclassifying it from distributable to actual common stock. Why don't you do that? And the reason is it's not that important to investors. Investors are going to look at it, they want to know how many shares are issued and outstanding, and they want to have some confidence in the numbers and the financial. And so we just don't do that part of the reclassification. This gets taken to paid-in capital in excess of par, and you don't have to change it down here and move it anywhere around. You keep it there. Stock splits. Oh my gosh, stock splits. No, just kidding. This is something that you in finance have probably read. They approve a 2-for-1 stock split to effect in the form of a 100% common stock dividend. So when they have wording like that, you're going to look at the wording. This problem is being included so you can look at the wording. The company wants to increase the number of shares to reduce the price per share of the stock. The total market capitalization is the same. You're just going to have more pieces of a pie. The pie is the same. There's more pieces to the pie. And then the words, to be effected in the form of 100% common stock dividend, means that when you do the journal entries, you need to treat it as if it is a 100% stock dividend. So this means if it's a stock dividend, there is a retained earnings adjustment, because anytime you have a dividend, you're going to debit retained earnings. You just jump to that conclusion. Even though they say it's a stock split, they want the investors to know that it's the same as a stock split, but when they do their financials, it's going to show up looking like a stock dividend. So for us, the important words are to be effected in the form of a stock dividend. So for some reason, they want to be debiting retained earnings or using up their retained earnings. They don't have to. They could have said it will be just a 2-for-1 stock split. They could have just stopped their sentence there and said, announced that it has approved a 2-for-1 stock split. They would record it as they do stock splits. There's no journal entry. We'll get into that, but there's no journal entry. No debit to retained earnings. That would have been the end of it. But because they added that phrase, to be effected in the form of a 100% common stock dividend, or it could have just said in the form of a common stock dividend, you know that in their accounting they're going to do journal entries. Well, what happens here? Well, the big thing here is that this is a large stock dividend, and because it's a large stock dividend, you're going to use par, and you're going to take par, which I think up here was 0.01001, sorry, very tiny par, and that's, you know, an arbitrary number. It depends on where they're incorporated and various other rules, and we aren't going to be concerned too much with that. I think we'll discuss it a bit in the outline. Anyway, multiply the 24.5 times the 0.001, and you come up with this number. So that's based on par. Another way you could tell it's par because there's no what account. There's no common stock paid in capital. The assumption I have with this sort of a journal entry is that it's all done in the time period. In other words, they're doing the distributable and the declaring and everything in the time period. And that's an assumption you have when you call it a stock split, because there's not the 2 periods of time really, it is all just one. It's the time when the stock split is done. Okay, you're assuming on that date when they declared the stock split, you are distributing it as well. That's an assumption. So if it would have been done as a stock split, what would we have done? This is your introduction to that. No journal entry. So that's the first thing. You would not be reclassifying. They call this reclassifying when you move from one part of equity to another. They call it reclassifying. No reclassification. All you're going to be doing here is when you write your caption, be sure to acknowledge that you no longer have the 24.5 million shares outstanding. You have twice as many, which is 49 million. And to get that to get your total common stock account to remain the same, because we have a formula, which is issued times par, right? You need to reduce par. And if you double one, you're going to half the other. That's just the kind of the algebra of the thing. So if we were to say triple the number of shares outstanding, then you would have thirded and take 1/3 of par. It's just an algebra thing. I'm assuming in this whole problem they don't have treasury shares when I'm doing all this stuff, by the way. I'm not going to get into the complexities involved in that. I'm just going to say that's an assumption. So before all of this, that common stock had a book value of 24.5, and after it still has a book value of 24.5. There's no journal entry, no changes in book value. And then another question here, what is a probable motivation for doing this? If we don't want to change the par value of the shares, then you can do it this way. When you do a journal entry, and it's your decision to do a journal entry, by the way, I'm going to say that some companies would do that instead of out of retained earnings, out of paid-in capital. I'm not going to get into any of that. I want you to always look at dividends as being debits to retained earnings. Just memorize debits to retained earnings. What if the stock price had been $36 at the time of the split? What would be the approximate value of the price? So they're talking about stock price. They're not talking about journal entries here. They're talking about a financial issue. If you're an investor and you have a stock split, what happens? Well, it probably goes to 18. Now, of course, in between time periods, things can change. Other things can hit the market at the same day, right? So I don't know, but you would expect it to be that. And another interesting fact I'm going to give you is that if you're an investor and you say had $1 million worth of Hammy's stock before the split, you would still have $1 million worth of their split, all things being equal, after it, of their shares after that split. So it's just that how many you have the same pie, It's just going to be in different pieces, you know. Twice as many shares at half prices, so the investors are not being hurt by these splits. All right, I'm going to be covering this outline in a separate PowerPoint and a separate, voiceover. And I'm going to do that so that you can go back and you can study it when it's time to study for your exam, which I think, I've looked at the calendar, it's coming up.